Bismillahirrahmanirrahim. Assalamu alaikum. This is Junaid Khalid, your course facilitator for F7 financial reporting paper. Okay, in this video specifically, I'm going to discuss the few changes that arose in your F7 financial reporting paper, and definitely this will be checked or this will be examined by the examiner in FR paper. So the first change that is encountered, that is the changes in the IFRS 15, that is revenues. If we just have an overview of that accounting standard in IFRS 15, there are many things which are discussed. That is the 5-step model, bill and hold arrangement, repurchase agreement, and there are the accounting for the agencies, many things which are discussed in this IFRS 15. But the change that has been encountered, that change specifically relates with the construction contract. We all know, I'm not going to discuss in detail what is construction contract and how we are doing the accounting for this one, why the separate accounting treatment is being discussed in this. So I'm not going to discuss it all in detail, but I'm going to discuss the changes that you may face in your exam. Okay, so construction contract. In construction contract, we all know that the impact of this construction contract will definitely be on the P&L side, and number 2 will be on the balance sheet side. Okay, if we exclusively talk about the P&L side, let's recall what we were doing in past. P&L, when we are recognizing revenues, cost and profit, so what was the accounting treatment? We might have 3 different options right now. Okay, we might have 3 different options. Number 1, if the contract is of a profitable contract. Okay, second situation could be if the contract is a loss-making contract, and third situation is that the contract is of no profit or no loss. Okay, no profit or loss. 3 situations you might face in the construction contract, that is whether it would be a profitable contract or a loss-making contract or a no profit or loss contract. So now what to do and what we were doing, let's quickly discuss this one. If we are having a profitable contract, let's discuss this scenario first. If we are having a profitable contract, so what accounting treatment we need to follow and what we were doing. Okay, let's recall this one. For instance, if we are having a profitable contract, what IFRS recommend that you first of all calculate the step number 1, you calculate the total profit, so that you could know that whether it's a profitable contract or a loss-making contract. Once you have calculated that it's a profitable contract, now step number 2, calculate the percentage of completion. And we all know that for the calculation of the percentage of completion, that is the percentage of completion may be calculated either through the input method or the output method. So there is no change in that one. Okay, step number 2 is as usual as we were doing. Okay, step 3 was that is to calculate the revenue recognized on the basis of the percentage of calculation, on the basis of the percentage of completion. Then how to recognize the revenue? Okay, let's recall. In order to recognize the revenue recognize, you need to have the contract price, the total contract price. Okay, total contract price multiplied by percentage of completion. Whatever the answer you received will be the amount of revenue recognized. Then what we were doing, okay, now I'm comparing, I'm having a comparison with the past treatment. What we were doing while recognizing the cost, that is cost recognition, how we were recognizing the cost recognition, that is the total cost, that is cost incurred to date plus, that is in addition, cost estimated cost to completion. I repeat my words, cost incurred to date plus estimated cost to completion, that is the total cost. The percentage of completion was applied on the total cost, and that was recognized as the cost recognized. That was recorded as a cost of sales, or we can say that the cost will be charged to the P&L. But now IFRS 15 has made it quite simple. There is no need to calculate, there is no need to apply the percentage of completion on the total cost. There is no need to apply the percentage of completion on the total cost. However, now the alternative treatment has been suggested by IFRS 15 is that cost recognized is equal to the cost incurred to date. Cost incurred to date. That's it. Now the IFRS 15 has made it a very simple accounting treatment that revenue recognized will be in the same way as we were doing, that is the contract price multiplied by percentage of completion. Now cost recognized will always be equal to the cost incurred to date. Remember what I am doing, right now I am having a situation that is the profitable contract. So in case of profitable contract, cost recognized will always be equal to what the cost incurred to date, and will make a difference of it. The amount which will be received is known as what the profit to be recognized. Profit to be recognized in P&L. So that was the accounting treatment with respect to P&L. And in P&L we might face three different scenarios, that is the profitable contract or a loss making contract or no profit or no loss. Okay, so that was the treatment. That was actually the change that you may face in your exam, so you must remember this one. Okay, now second thing is, what if it's a loss making contract? What if it's a loss making contract? So what would be the change, or what would be the accounting treatment? So there is no as such I would say change in this situation. If it is a loss making contract, now how would you account for? IFRS 15 recommend that if you have calculated the total profit or loss and you saw that there is a total loss, it means in a contract you will be facing a loss. So IFRS 15 states as, first of all, just recognize that loss. Whole loss should be recognized, and we all know that that loss is recognized as an onerous loss under IAS 37. Under IAS 37. Okay, now revenue recognized should be calculated in the same way, that is the contract price multiplied by the percentage of completion, and cost would be the balancing figure. I repeat, cost would be the balancing figure. So if I could see that there is no as such change in the loss making contract. Okay, now third situation is, what if no profit or loss? No profit or loss. For example, if the company states that it is quite unpredictable, that management cannot predict whether the company will have a profit, so in that situation IFRS recommends that whatever the cost to date incurred will be recognized as a revenue. It means if the cost incurred to date is 500, revenue recognized would be 500. It means no profit or loss would be recognized. So that was the accounting treatment with respect to P&L. In P&L we might face three different options, three different scenarios, and we just have a look of it, that in what scenario what would be the accounting treatment. In short, if I sum up, there is only a change in the profitable case. Okay, now moving back to the moving towards the balance sheet side. In balance sheet side, we all know that we recognize the contract asset or contract liability. Contract asset or liability. Earlier, to calculate the contract asset or liability, there was a very difficult formula, or there was a very complicated formula, that is the cost to date. In addition, we recognize the profit recognized to date, and then we just deduct the amount invoiced. Now IFRS 15 made it quite simple. Now in order to calculate the contract asset, what we need to do, that is revenue recognized to date. Okay, remember, it's not a revenue for the year, it's a total revenue recognized to date. For instance, if you are calculating the contract asset, so for the last 3 years, whatever the revenue recognized will be the amount here, you need to put it on. Okay, revenue recognized to date less any amount invoiced amount. Okay, whatever the amount you have invoiced to customer will be deducted from this one. This will be known as what? The contract asset. Okay, so revenue recognized to date less any amount invoiced to customer, that the difference would be recognized as a contract asset. If that amount is positive, it's a contract asset, and if that amount is in loss, it means in a negative figure, that would be recognized as a contract liability. Okay, one more thing, revenue recognized to date, that whatever the, for example, if we have recognized a revenue of 1000 and we have billed to the customer, that is we have sent a billing to the customer, that is 800. Okay, 800 is the billing to the customer, so 200 definitely would be recognized as a contract asset. Okay, now we have invoiced the amount of 800. Might be possible, there is a possibility the customer might have paid out of 800 would have paid 600. Okay, customer has paid you the amount of 600, it means that still 200 is yet to be recovered, still 200 yet to be received, and the difference would be recognized as what the account receivable. Okay, that difference would be recognized as what the account receivable. So amount invoiced minus the amount received is equal to what the amount to be recovered from the customer, that is the accounts or the trade receivables. Okay, that was the contract asset and liability. So two changes which we have seen in this video. Number one, the first change was in the profitable side. If the contract is of a profitable nature, what would be the change? And the second change was on the calculation of the contract asset or the liability. Okay, now moving towards the another change which you might face in your paper, that is the changes in the consolidation, specifically in the associate accounting treatment. Now let's have a look what is that change and how you need to answer the questions of your examiner or the paper. Okay, second change in the consolidation or in the associate company accounting. Now what is that change? Earlier we were supposed to do what we were supposed to do, that is if the parent sells some goods to the associate company, or if associate sells goods to parent company. The accounting treatment was simple. IFRS said that in earlier, if I just talk about the past treatment, accounting treatment, IFRS used to state that whether the P company or the parent sells goods to associate company, or the associate sells goods to P company, whatever the URP, whatever the unrealized profit is there, the simple accounting treatment would be share of profit in associate. Okay, SPIA, that's a short form. Share of profit in associate would be debited and investment in associate would be credited. That was a simple accounting treatment. Okay, that was in the past, but recently now IS 28 states that now this would not be the proper accounting treatment. Now the accounting treatment would depend whether the parent sells goods to a company, that is associate, or associate sells goods to a parent company. Now let's have a recall on this one, and that stream is known as what? Downstream. That parent is selling goods to the associate, it is known as what? A downstream, and that stream is known as what? The upstream. That is the associate is selling goods to the parent company. Okay, now if parent is selling goods to the associate company, now what would be the accounting treatment? IAS 28 recommends that while if the parent is selling goods to the associate company, the accounting treatment would be, now what would be the accounting treatment? If parent is selling that goods, now the unrealized profit need to be removed from the cost of sales of a P company, and the other impact would be on the investment in associate will be credited. Cost of sales of a parent company would be debited and investment in associate would be credited. And if we talk about the associate to parent, what if the associate sold goods to parent company? Now what would be the accounting treatment? Share of profit in associate would be debited and inventory of P company would be credited. Although it's a complicated one, but it's a logical one. If parent is selling goods to the associate company, there is a need to remove that unrealized profit from the cost of sales of the parent company. and investment and because URP, that is unrealized profit, it's in the associate company accounting, and we are not consolidating the line items of associate companies, so the ultimate treatment would be on the investment in associate side. So investment in associate would be reduced. Other accounting treatment, that is if associate is selling goods to the parent company, now the accounting impact would be on the share of profit in associate, as now the profit is in the accounts of associate company, will reduce the share of profit in associate, and definitely that URP is in the balance sheet or in the inventory accounts of a P company, so inventory would be reduced by that unrealized profit. And one more thing, definitely you must know about it, it's not a change but it's a quickly recall, I'm just quickly recalling that one, that whatever the URP is, URP will not be deducted. Basically the share of URP, what I said, share of URP. For instance, if you are having an unrealized profit of 3,000 and we have acquired 30% shares, so it means 30,000 into 3,000 into 30%, this means the 900 is the amount of URP that will be reduced according to that accounting treatment. Okay, that is the impact. And one more thing, there will be an impact on the balance sheet, that is if we are debiting the cost of sales, so we will be debiting the group retained earning. It means don't forget to have an impact on the group retained earning account. Share of profit in associate is debited, which means again the group retained earning account would be debited. So let's quickly sum up. If parent is selling that those goods to the associate company, that treatment would be done from the cost of sales, that URP will be eliminated from the parent company cost of sales, and associate investment in associate would be reduced. If associate is selling those goods to the parent company, that means share of profit in associate would be reduced, and that is inventory of parent company will also be reduced. No doubt there will be an impact on the group retained earning account. There will be an impact on the group retained earning account while preparing the consolidated statement of financial position. So that was the changes you might face in your exam. So it's quite necessary that you must recall all these one. Okay, so best of luck for your paper. Thank you so much.